I've spent my entire career looking at financial statements that don't add up. Numbers that seem too good to be true, accounting tricks that hide the truth, management teams that speak in carefully crafted lies. And I can tell you from decades of experience, fraud is everywhere. It's not the exception in finance. It's closer to the rule. Most people don't see it because they don't know what to look for. They trust the audited financials. They believe the earnings calls. They assume that sophisticated investors and regulators are doing their job. They're wrong. I'm Michael Burry, and I made my name by seeing what others refused to see. By digging into the data when everyone else was satisfied with the story, I predicted the subprime mortgage crisis when the entire financial industry was telling me I was crazy. I shorted the housing market when banks were still rating mortgage-backed securities as AAA. And I did it by recognizing fraud and deception hiding in plain sight. Today, I'm going to teach you how to spot the same things I look for. The red flags that tell you a business is lying. The behavioral patterns that reveal dishonest management. The accounting games that inflate earnings. Because if you're going to survive in this market, you need to understand that not everyone is playing by the rules. And the ones who aren't playing by the rules are often the ones making the most noise about their success. Let me start with something fundamental that most investors never truly understand. People give themselves away. When I'm evaluating a business or meeting with management, I'm not just looking at the numbers on a spreadsheet. I'm watching how they present those numbers, what they emphasize, what they ignore, what they laugh about, what they get defensive about. The clues are always there. You just have to know what you're looking for. I learned this early in my career, but it really crystallized for me when I was researching mortgage-backed securities in the mid-2000s. I would read these prospectuses for mortgage bond offerings, hundreds of pages of legal language and financial data, and buried in there would be these little admissions, footnotes about how many loans were stated income, meaning no verification, disclosures about how many borrowers had FICO scores below 600. But when you talk to the people selling these bonds, they never mentioned those details. They talked about the AAA rating, the diversification, the historical performance of real estate. They were giving themselves away. They were showing you what they wanted you to focus on, which told you exactly what they were trying to hide. This happens in every fraudulent or deceptive business I've ever encountered. Management tells you what matters to them. And what matters to them is usually either making the numbers look good or distracting you from problems. Honest management talks about the business, the products, the customers, the competitive landscape, the challenges they're facing, and how they're addressing them. Dishonest management talks about the stock price, the earnings beat, the adjusted EBITDA, the non-GAAP metrics that somehow always make things look better than GAAP. Let me give you a specific example from my own experience. When I was analyzing financial companies before the crisis, I would read their conference calls. The banks that were hiding problems would spend the entire call talking about their Tier 1 capital ratios, their return on equity, their efficiency ratios. All these metrics that sounded impressive but didn't tell you anything about the quality of their assets. The banks that were being honest would talk about their loan portfolio. What percentage were commercial real estate? What the delinquency trends looked like in different segments. What they were seeing from borrowers. One group was trying to impress you with numbers. The other group was trying to explain their business. Guess which group survived the financial crisis? Now, let me talk about a specific type of fraud that I see constantly in financial statements. Reserve manipulation. This is particularly common in insurance companies and banks, but you see versions of it in any business that has to estimate future liabilities or losses. Here's how it works. Let's say you're an insurance company. You collect premiums today, but you'll have to pay claims in the future. You have to estimate how much those future claims will cost and set aside reserves to cover them. If you're honest, you make conservative estimates. You assume claims will be higher than your best guess because it's better to over-reserve and have extra money than to under-reserve and run out. But if you're trying to manipulate your earnings, you can just lower your reserves. You assume claims will be lower than your best guess. Suddenly, you're setting aside less money, which means you can report higher earnings. It's completely legal as long as your estimates are reasonable. And reasonableness is subjective. I've seen this game played over and over. A company is about to go public, and mysteriously, their reserves drop in the year or two before the IPO. Their earnings look great. They get a high valuation. The executives make a fortune. Then a few years later, after the lockup period expires and the insiders have sold their stock, the reserves quietly start increasing again. Earnings disappoint, the stock crashes. But by then, the fraud is complete. The insiders extracted their money. The public shareholders are left holding the bag. This exact pattern played out with multiple financial companies before the 2008 crisis. They were under-reserving for loan losses, reporting inflated earnings, and paying themselves massive bonuses based on those fake earnings. When the loans actually started defaulting, they had to massively increase their reserves. Earnings collapsed. Stock prices collapsed. Some of them went bankrupt. But the executives who ran these companies during the fraud years, they kept their bonuses. They kept their stock sale proceeds. They walked away rich while shareholders lost everything. Let me share another pattern I see constantly. The promotion of non-GAAP metrics. GAAP stands for Generally Accepted Accounting Principles. It's the standardized way that companies are supposed to report their financial results. But many companies don't like what GAAP shows, so they invent their own metrics. Adjusted earnings, EBITDA, adjusted EBITDA, free cash flow before certain expenses, operating income before restructuring charges. They always have a justification. They'll say GAAP doesn't reflect the true economics of the business, that certain expenses are one-time charges that won't recur, that investors should focus on these adjusted metrics to understand the company better. And sometimes that's legitimate. Sometimes GAAP really doesn't capture the economics well, and adjusted metrics provide useful information. But most of the time, when I see a company aggressively promoting non-GAAP metrics, it's because the GAAP numbers look terrible. I had an experience recently that perfectly illustrates this. I won't name the company, but they were pitching themselves as an acquisition target. They told us they were earning $100 million a year. But when we looked at their GAAP financials, they were only earning $90 million. Where did the extra $10 million come from? Stock-based compensation. See, they were paying their executives and employees partly in stock options. Under GAAP, you have to expense stock-based compensation. It reduces your earnings, but this company wanted us to ignore that expense. They said that as a private company, they had to pay people in cash, which was expense. But if we bought them, we could pay people in stock options, which wouldn't be expensed or at least wouldn't really count. So they wanted us to pay them for $100 million in earnings, even though they were only earning $90 million, based on the idea that we could make the numbers look better by using questionable accounting. Think about the logic here. They're asking us to pay more for the business because we can lie about the earnings better than they can. This is the kind of proposal I get from investment bankers and private equity firms constantly, and it tells me everything I need to know about the people I'm dealing with. If your sales pitch is based on accounting manipulation rather than actual business value, you're not someone I want to do business with. Let me tell you about another experience that taught me a lot about how frauds operate. We received a proposal from a private equity firm. They were trying to sell us a company they owned. As part of the process, we got access to their internal emails and projections. And we saw an email from the private equity firm to the company's management team. The email said, and I'm paraphrasing here, make sure your projections show 15% higher growth than you think is realistic, because Burry will discount them by 15 to 20% anyway. They were explicitly telling management to inflate the projections to offset my expected skepticism. Now, this email wasn't supposed to get to us. It was a mistake. Someone forwarded the wrong version of something. But it confirmed what I already suspected. Private equity firms routinely tell companies to inflate their projections when they're trying to sell them. They assume that buyers will be skeptical and discount the projections. So they tell sellers to inflate the numbers to compensate. It's a game. And everyone knows it's a game. But they keep playing it because sometimes it works. Sometimes a buyer is naive enough or desperate enough to believe the inflated projections. This is why I'm so skeptical when I evaluate businesses. I assume that everything I'm being told is optimized to make me pay the highest possible price. I assume that every projection has been inflated. I assume that every metric has been cherry-picked to look as good as possible. And even with that level of skepticism, I still occasionally get fooled. Because some frauds are really, really good at what they do. Let me talk about a specific type of fraud that I encountered repeatedly when I was researching the housing market. Stated income loans, also known as liar loans. The concept was simple. Instead of requiring borrowers to document their income with tax returns and pay stubs, lenders would just let borrowers state their income. The borrower would say, "I make $100,000 a year," and the lender would write down $100,000 without verifying it. The justification was that this made the process easier for self-employed borrowers or people with complicated income sources. And for a small percentage of borrowers, that was true. But for most stated income borrowers, it was just fraud. They were lying about their income to qualify for loans they couldn't afford. And the lenders knew this. The entire industry called them liar loans. They knew borrowers were lying. They originated them anyway because they could sell them to Wall Street, which would package them into mortgage-backed securities and sell them to investors. When I started researching these securities, I found prospectuses where 50, 60, even 70% of the loans were stated income. Think about that. More than half the borrowers in these pools had not proven they could afford the loan. They had just claimed they could afford it. But these securities were rated AAA. The rating agencies said they were as safe as U.S. Treasury bonds. How is that possible? How can you have a pool of loans where most borrowers haven't proven their income and rate it as having essentially zero risk of default? The answer is fraud. Sophisticated, institutional, widely accepted fraud. The rating agencies were being paid by the banks that were creating these securities. They had every incentive to give high ratings. If they gave low ratings, the banks would take their business to a different rating agency. The banks knew the loans were garbage, but they didn't care because they were selling them immediately. They weren't holding the risk. The investors buying these securities were either ignorant or didn't care because they could leverage them up and the fees were so good, everyone was making money. So nobody asked hard questions. This is how fraud operates at scale. It's not one bad actor. It's an entire ecosystem of participants who all benefit from the fraud and therefore all have an incentive to keep it going. And the people pointing out that the emperor has no clothes, people like me, are dismissed as cranks or pessimists or people who don't understand the new paradigm until the fraud collapses. Then suddenly, everyone claims they saw it coming all along. Let me share some specific techniques I use to identify fraud in financial statements. First, I look at the relationship between revenue, earnings, and cash flow. In a healthy business, these three metrics should move roughly together over time. If revenue is growing fast, but cash flow is flat or declining, that's a red flag. It suggests the company is booking revenue that isn't generating actual cash. Maybe they're being aggressive with revenue recognition. Maybe they're stuffing inventory into distribution channels and calling it sales. Maybe the sales are real, but the customers aren't paying. Second, I look at the relationship between accounts receivable and revenue. Accounts receivable represents money that customers owe you for products or services you've delivered. In a normal business, accounts receivable should grow roughly in line with revenue. If you're growing revenue by 20% per year, receivables should also grow about 20%. If receivables are growing much faster than revenue, that's a red flag. It suggests you're booking sales but not collecting the cash. Either your customers are having trouble paying or you're booking fake sales. Third, I look at the pattern of earnings beats. If a company beats earnings expectations by exactly 1 or 2 cents per share every single quarter for years, I get suspicious. Real businesses have variability. Sometimes you beat by a lot, sometimes you miss. Sometimes you beat by a little. If you're consistently beating by exactly 1 or 2 cents, it suggests you're managing earnings. You're using accounting tricks to smooth out the natural variability and hit the number Wall Street expects. Fourth, I look at the footnotes. The real information in financial statements isn't in the big bolded numbers at the top. It's in the footnotes at the bottom that nobody reads. That's where companies disclose their accounting policies, how they recognize revenue, how they value inventory, how they calculate reserves, what assumptions they're making about pension liabilities. If you read the footnotes carefully, you'll often find admissions that completely change your understanding of the business. I'll see a company reporting strong earnings growth, then I'll read the footnotes and discover they changed their revenue recognition policy to be more aggressive, or they lowered their reserve assumptions, or they're using some non-standard valuation method for assets. The earnings growth isn't coming from better business performance, it's coming from accounting changes. Fifth, I pay attention to management turnover, especially CFO turnover. If a company goes through multiple CFOs in a short period, that's a huge red flag. The CFO is the person responsible for the financial statements. If CFOs keep quitting, it usually means they're being asked to do things they're not comfortable with. Either the CEO is pressuring them to use aggressive accounting, or they've discovered problems they don't want to be associated with, or they're being set up as scapegoats for fraud that's going to be discovered later. Honest companies have stable finance teams. Fraudulent companies burn through CFOs. Now let me talk about the behavioral patterns I look for when I'm meeting with management teams. The first pattern is excessive focus on the stock price. When executives spend a lot of time talking about their stock price, how it's undervalued, how the market doesn't understand them, how they're committed to creating shareholder value, I get nervous. Good executives focus on building the business. They talk about customers, products, market opportunities, competitive advantages. They trust that if they build a good business, the stock price will take care of itself. Executives who are overly focused on the stock price are usually either trying to pump it for an insider sale, or they're compensated heavily in stock options and are managing the business to maximize short-term stock price rather than long-term value. The second pattern is vagueness about specifics. When I ask detailed questions about the business and get vague answers, that's a red flag. If I ask, what percentage of your revenue comes from your top 10 customers? And they say, we have a very diversified customer base. Without giving me a number, they're hiding something. If I ask, what's your customer retention rate? And they say, our customers are very satisfied. Without giving me a number, they're hiding something. Honest management gives you numbers. Dishonest management gives you adjectives. The third pattern is aggressive attacks on short sellers or critics. If a company spends a lot of time and energy attacking people who question them, that's a red flag. Confident management addresses criticism with facts. They explain why the criticism is wrong using data and logic. Defensive management attacks the critics personally. They call them short sellers with an agenda. They accuse them of spreading false information. They threaten lawsuits. This pattern was incredibly common with the mortgage companies I shorted before the financial crisis. When analysts started questioning their loan quality, they didn't provide detailed data about their loan portfolios. They attacked the analysts as pessimists who didn't understand the housing market. That told me everything I needed to know. The fourth pattern is excessive complexity. When a business model is needlessly complicated, with multiple subsidiaries, off-balance sheet entities, special purpose vehicles, and convoluted corporate structures, I get suspicious. Sometimes complexity is necessary. Large multinational companies operating in many countries need complex structures, but often complexity is designed to hide fraud. Enron was the classic example. They had thousands of subsidiaries and special purpose entities designed to keep debt off their balance sheet and hide losses. If I can't understand a company's structure after serious effort, I assume they don't want me to understand it. And if they don't want me to understand it, it's usually because understanding it would reveal fraud. The fifth pattern is frequent restatements of historical financials. If a company keeps having to restate their previous financial results, that's a massive red flag. Mistakes happen. Sometimes a company genuinely makes an accounting error and has to correct it. But if a company is restating financials repeatedly, it means either their accounting department is incompetent, which is bad, or they're playing games with the numbers and getting caught, which is worse. Either way, you can't trust their financial statements. Let me tell you about one of the most important lessons I learned about fraud. It came from Charlie Munger's story about the Fidelity bond claim. Charlie ran a small investment firm back in the 1960s. One of his employees stole $12,000. Charlie's firm had insurance that was supposed to cover dishonest employees, so he filed a claim. The insurance company denied the claim. They came up with all kinds of excuses. The employee wasn't really an employee. The theft wasn't really a theft. Whatever they could think of to avoid paying. Now, Charlie could have spent months or years fighting this claim in court. But $12,000 wasn't worth that much of his time. The insurance company knew this. They were counting on it. They figured Charlie would give up rather than spend the time and money to pursue $12,000. But Charlie understood what they were doing. So he wrote a letter to the chairman of the insurance company. He said, "I know that you would never intentionally use your superior resources to avoid paying a legitimate claim. That would be beneath you. So I have a proposal that will eliminate any appearance of unfairness. Let's multiply the claim by 10. Instead of $12,000, let's make it $120,000. If you win, I pay you $120,000. If I win, you pay me $120,000. Now the stakes are high enough that it's worth my time to pursue this properly." He got a check for $12,000 by return mail. This story illustrates something crucial about how frauds operate. They rely on asymmetric costs. It costs them almost nothing to deny your claim or cheat you. They have a legal department on salary anyway. They can drag things out forever. But it costs you a lot to fight back. You have to hire lawyers. You have to spend your time. You have to take the risk of losing. So they make calculated bets that you won't fight back. And most of the time, they're right. This happens in financial fraud all the time. Companies make small, fraudulent charges that aren't worth fighting individually. They overcharge customers by small amounts. They engage in deceptive practices that harm people in ways that are too small for individual lawsuits. But when you add it up across millions of customers, it's massive fraud generating massive profits. And they get away with it because the cost of fighting back is too high for individual victims. The solution is class action lawsuits and regulatory enforcement. But those are slow and imperfect. Most fraud goes unpunished. Let me talk about the current environment for fraud and deception in finance. I believe we're in one of the most fraud-prone environments I've seen in my career. And I lived through the dot-com bubble and the housing bubble. The reason is simple. We've had over a decade of extremely low interest rates and easy money. When money is free, discipline disappears. Investors stop asking hard questions because everything is going up. Why do due diligence when you can just buy and watch it appreciate? Companies can raise money easily, so they don't need to be profitable or have sound business models. They just need a good story. This creates perfect conditions for fraud. Companies can go public or raise private funding with minimal revenue, no profits, and business models that make no economic sense. I'm seeing companies valued at billions of dollars that have never made a profit and have no clear path to profitability. I'm seeing revenue multiples that make no sense for the actual economics of the business. And I'm seeing accounting games that would have been obviously fraudulent 20 years ago, but are now accepted as standard practice. Stock-based compensation that companies insist you should ignore. Adjusted metrics that bear no relationship to GAAP. Revenue recognition policies that book revenue before services are delivered or products are used. The growth at all costs mentality has created an environment where fraud is not just tolerated but rewarded. Companies that play the game best, that tell the most compelling stories and use the most aggressive accounting, get the highest valuations. Honest companies that report conservative numbers and acknowledge their challenges are punished by the market. This can't last forever. It never does. Eventually, reality reasserts itself. Companies that aren't actually profitable run out of money. Accounting games get exposed. Frauds collapse. And when that happens, a lot of people are going to lose a lot of money. My job is to position myself to profit when that happens, just like I did with subprime mortgages. But it's not easy, because markets can stay irrational longer than you can stay solvent, as Keynes said. I was early on the housing crisis. I started shorting subprime in 2005. The market didn't collapse until 2007. That's 2 years of being right but losing money because the market hadn't figured it out yet. A lot of investors couldn't handle that. They pulled their money out of my fund. They thought I was wrong, but I wasn't wrong. I was early. And being early cost me investors and reputation in the short term, even though it made me and my remaining investors a fortune in the long term. That's the challenge with fighting fraud. The fraud can persist for years before it collapses. And if you're betting against it, you have to survive long enough to be proven right. Let me give you some practical advice for protecting yourself from fraud as an investor. First, if something seems too good to be true, it probably is. I know that sounds obvious, but people forget this all the time. If someone is promising you returns that are way above market rates with no risk, it's fraud. There is no secret investment strategy that generates 20% annual returns with no risk. If there were, the person wouldn't be sharing it with you. Second, be skeptical of complexity. If you can't understand how an investment makes money, don't invest in it. Warren Buffett has a rule that he won't invest in businesses he doesn't understand. That's a good rule. If an investment requires a PhD in mathematics to understand, or involves complicated derivatives, or has a structure you can't diagram on a napkin, pass. Complexity is often designed to hide fraud. Simple businesses with straightforward economics are much less likely to be fraudulent. Third, do your own research. Don't rely on other people's due diligence. Just because an investment bank is selling it, or a rating agency has blessed it, or other sophisticated investors have bought it, doesn't mean it's legitimate. Remember, all three rating agencies gave AAA ratings to subprime mortgage securities that were absolute garbage. The most sophisticated investors in the world bought them. Everyone was wrong. Or more accurately, everyone had incentives to pretend something was safe when it wasn't. You can't outsource the work of understanding what you're investing in. Fourth, pay attention to incentives. How is the person pitching you this investment getting paid? If they're getting paid based on how much you invest, regardless of whether you make money, their incentives are not aligned with yours. If they're getting paid enormous fees up front, they don't care if the investment works long term. Always ask yourself, how does this person make money if I lose money? If the answer is that they still make money, be very careful. Fifth, trust your gut. If something feels off, it probably is. I can't tell you how many times I've looked at an investment that looked good on paper, but something about it bothered me. Maybe the management team seemed evasive. Maybe the business model had a logical gap I couldn't quite articulate. Maybe the numbers were too perfect. And almost every time I ignored that gut feeling and invested anyway, I regretted it. Your intuition is your brain processing patterns that you may not be consciously aware of. When something feels wrong, listen to that feeling. Finally, accept that you're going to miss opportunities. The cost of avoiding fraud is that you'll pass on some investments that turn out to be legitimate. I've passed on investments that seemed too good to be true and turned out to be real. I've avoided businesses I didn't understand that made other people a lot of money. But I've also avoided countless frauds and blown up investments. And on balance, being too cautious has served me much better than being too aggressive. In investing, it's not about hitting home runs. It's about not striking out. It's about staying in the game long enough to compound your returns over decades. And you can't compound if you get wiped out by fraud. So be skeptical, do the work, trust patterns over stories. And remember that people give themselves away if you know what to look for. The frauds are out there. They're well-dressed, well-spoken, and backed by prestigious institutions. They have impressive credentials and compelling presentations. But if you look carefully at the numbers, listen carefully to what they emphasize and what they avoid, and pay attention to the patterns I've described, you can spot them. And once you can spot them, you can either avoid them or, if you're positioned correctly, profit when they inevitably collapse, because they always collapse. Fraud is unsustainable by definition. The question is just when, not if. My entire investing philosophy is built on finding situations where I can see reality more clearly than the market does, where I can identify fraud or deception or unsustainable situations before they become obvious to everyone else. It's not easy. It's lonely. It requires going against consensus and being comfortable being wrong in the short term while waiting to be proven right in the long term. but it's the only way I know to generate true alpha in markets. Because if you're just doing what everyone else is doing, you're going to get the same returns as everyone else. And when everyone else is buying into frauds and bubbles, the same returns as everyone else means losing money.